Jeremy and Rishi recently unveiled their autumn budget and it came with some interesting data. For a while now, we've been waiting for this big ticking time bomb on mortgages in the housing market, and so far, it just hasn't happened. About a year ago, I predicted that relatively speaking, house prices would not crash, and at worst, we'd see a 10% drop. I was right, but I was also wrong. Let me explain. This graph from the Office for National Statistics shows house prices so far. We peaked in July 2022 when things were super hot and have since seen prices fall year on year from highs of 13% year on year to pretty much flat at 0.1%. But that doesn't tell us how far property prices have fallen. Naturally, when you have a super hot property market like we've had with 13% growth year on year, at some point that has to cool down. So even though the growth has slowed down, the actual market is still hovering at the top. It's a bit like inflation. Rishi is celebrating halving inflation, which is for news headlines and it sounds great, when in fact inflation is still just under 5%. Even though it's slowed down, prices are firstly still very high, and secondly they're increasing 5% versus last year. So measuring stats like this can be easily misunderstood. Let me show you some actual house prices. You can see that 13% growth caused a sharp increase. We had a wobble in 2023 and ending the year still at the top, with the difference between the pre and post pandemic putting property prices almost £60,000 more expensive on average, which is 26% more expensive. When you look at it this way, at actual house prices, there's been no crash at all. Pretty much nothing has happened. The market hasn't gone up, but more importantly, it hasn't gone down. To understand this a little bit deeper, we need to look at some of the economics around the housing market right now to see if there's any obvious indicators. Zoopla have looked at general activity in the market and sales agreed. Now, when you look at the post-pandemic boom to today, it looks like things are heading down. But when you compare it against more stable and normal times, surprisingly, activity is still higher in 2023 than it was in 2017 to 2019 when rates were sub 2%. Overall, new sales agreed are up 15% versus last year when the rates hit their peak, and we're still 5% higher than in 2019 in terms of activity. So we know activity isn't as hot as the previous 2 years, but it's still high when looking at the past 5 to 6 years. There are buyers out there. Let's look at mortgages and arrears data to see if anything funny is going on there. UK Finance, who track arrears data, released their Q3 update. They stated that there were 87,930 homeowner mortgages in arrears of 2.5% or more of the outstanding balance in the third quarter of 2023, 7% greater than in the previous quarter. Interesting. Year on year, there's 18% more households in arrears than before, with almost 90,000 mortgages in arrears by more than 2.5% of the outstanding balance. What does this mean? Well, something is happening in the market, but we're not seeing any impacts yet. The housing market moves very slowly, and with so much activity in the market, motivated sellers for now aren't normal households. But if banks have more and more houses to sell, then possibly we'll start to see them bring the average prices down a little bit if arrears are increasing to repossessions. But when you look at the mortgage possession data, in the third quarter of this year, there were only 630 homeowner homes repossessed by lenders. That's not a lot at all. When you compare this to the 2008 data and this graph I took from the government blog, repossessions in their peak back in 2008 were somewhere around 12,000 actual repossessions in a quarter and up to 41,000 active claims. So here, for now, even with rates being higher, yes, it's reduced affordability and everyone has been knocked down a peg or two in the housing market, but it's stable. So that's not also a contributing factor to any of the dips right now.
Speaking of properties, did you know a great way to build a deposit is by saving into an ISA, which is why this video is conveniently sponsored by InvestEngine.
InvestEngine are leading the way in providing all you need to invest. You can build your own portfolio for free, and they have some great tools to help you automatically invest weekly, fortnightly, or monthly. They specialize in exchange-traded funds, which is an ideal way to invest in shares, stocks, bonds, gold, and more, giving you access to hundreds of companies such as Apple, Tesla, Nvidia, all in one go. Plus, if you're not sure what to pick, you can use their managed portfolio service where InvestEngine builds and manages an investment portfolio for you from a range of investments, ensuring that your money is diversified to help manage risks. They're ideal for your ISA or pension, and setting up an account is free and easy, either as an individual or like me, under the name of your company. And then you're good to begin investing money into one of the many ETFs that they have to offer through popular investment companies like Vanguard, iShares, JP Morgan, WisdomTree, and more. And if you're not familiar with InvestEngine, their accounts are FSCS protected up to £85,000, and all steps are taken to secure customers' funds by adhering to UK law, just as you'd expect from any compliant regulated financial services company in the UK. They're authorised and regulated by the Financial Conduct Authority, so why not give them a try and save yourself hundreds in investment fees that the old platforms still charge? So let's talk about mortgage rates. Because we know the housing market growth has slowed down, something is cooling off. Quite obviously, the interest rates have been a major factor in this, with the Bank of England raising the base rate as high as 5.25%. For mortgages, we've seen peaks as high as 7 to 8%. These days, for a 2-year fix, rates are anywhere from 5.3% to 5.4%. However, to keep rates somewhat lower, you'll notice lenders are upping their product fees. So when you look at APRC, or annual percentage rate of charge, it's a term used to describe the overall cost of a mortgage loan expressed as an annual percentage. It's a more comprehensive measure than the interest rate alone, because it includes not only the interest rate, but also any of the charges you have to pay for the loan, such as the arrangement fees. Likewise, on 5-year fixes, the interest rate is a bit lower, sub 5%, but the product fees remain, making the APRC somewhere around 8 to 9%. This does also include the standard variable rate after the fixed portion of the mortgage. And what this all means is that mortgages are still a lot more expensive than what they used to be, and I don't think they'll massively drop anytime soon. What I did find interesting was looking at discounts from the asking to achieve price in the past 5 years. This is often a good indicator of where seller versus buyer expectations actually are. I don't know about you, but I get the feeling sellers are still trying to ride the post-pandemic hype, even though it's all over now. And likewise for estate agents, not because their expectations are mismanaged, but estate agents, of course, want to milk the cash cow for as long as they can. So when you look at the start to the end of 2023, the discounts are getting bigger, meaning there's a bigger disparity between what a seller wants and what a buyer is willing to offer. This will naturally begin to bring house prices down, and since we saw the 12% drop year-on-year growth, now we're at the break-even point. If it continues, that's when we'll start to see some actual reductions in property prices. And when you factor in the number of homes on the market and the supply is increasing, it means that the balances are tipping back into a buyer's market, which for some will be very refreshing not to be competing in bidding wars. So when is the best year to buy a house? My short answer is that if you're living there for the long term, then just go for it and stop waiting. For those people pre-pandemic that thought they'd wait, houses are now 24% more expensive compared to if they had just bought then. The market now is more challenging for buyers, but as a buyer, you're better positioned because it's definitely a buyer's market. And for me, that's the best time to buy because there are a lot of people who bought during the seller's market hype post-pandemic, bidding 20 to 30% over asking prices and house values themselves, just to get a dream house that they want, and now they're probably stuck in negative equity. If you want the official 8-ball stats, then the Office for Budget Responsibility are forecasting that the housing market decline has already started, which is true. However, they did forecast that by Q3 2023, we'd see a 7.2% year-on-year growth by the end of 2023, when in fact, we're at about minus 1.2%, so they're quite off. But they did predict that going into Q1 2024, that's the largest house price decline year-on-year. Before then, the negative market cools off, and it's a more stable 2 to 3% year-on-year growth again. Think of it as managing risk. As long as you don't buy for a silly price and stretch your finances and end up with a negative equity with a massive mortgage that's too hot to handle, then you'll likely be okay. If you enjoyed this video and you're saving up for a deposit, then check out this video here on stocks and shares ISAs and how I invest and save my money. So click on this video here, check it out, and I'll see you in the next video.